Again, the chat window is up, so you guys got any questions, you guys can type it there. And here is the same sheet of music they're working off of. Here's the web page with the link to the book club notes. It's getting pretty long now. Thanks for helping out with this. So this is the Tax-Free Wealth by Tom Wheelwright. We're going to be diving into chapter 12 to 15. We'll just be kind of going through these topics, and if something comes up or you guys want to discuss something, let me know. But before we get started, somebody asked last time, like, the silver bullet for all these 401k withdrawals is like the QRP. So if you guys want to get hands on this free book, go ahead to simplepassivecashflow.com/QRP. I think Damon's still giving those out, so I think the links should still work. So simplepassivecashflow.com/QRP. But I wrote a bunch of stuff there. I'm not a big fan of the 401k or the self-directed IRA these days. Nor any retirement account. But if you're going to use any retirement accounts, use the QRP or a solo 401k. So we get started here. The first point I have that I read was this whole usage of like an S corp to do a salary dividend split. Is anybody actually using this that's on the call? So the basics of this is you should have like a holding company with all your rental properties flow to and all your active real estate properties flow to. And this is mainly speaking to more of the active folks, like the guys with the flippers, those guys who are doing a bunch of stuff. But eventually I'm kind of working towards this, that I'm going to get all my stuff come to like one holding LLC. And then that LLC gets turned into, it's still LLC, but it gets taxed as an S corp. So at that point, you can start to take some stuff as a dividend, which we learned in the previous chapter. We can avoid the self-employment tax, and some of it goes off as salary. So unfortunately there you can't avoid the self-employment tax, but you get a good portion of it to avoid it. And there's definitely a game being played there, and you want to minimize your salary, but you don't want to take too little bit of a salary because the IRS will flag you. So the salary.com there is a good resource for that. But in my opinion, that's where you get the professionals involved when you start implementing those kinds of things. Page 115, 116, deducting sales tax items. I didn't know you could really deduct these kinds of, I mean, I kind of did at some point, but it was nice that they outlaid it out, the manufacturing equipment, inventory, R&D equipment, purchases for other supplies. I know a guy, and this is not me for sure, but like they bought like those Segways back in the day, and they called it R&D. And back then there was like a credit for R&D. But I don't know, in my opinion, that's a little bit aggressive. But I think the point is to kind of look what you buy, look at the things you're already buying and seeing if it falls into that category. Anybody use any of that manufacturing equipment, inventory, R&D equipment, purchases for other supplies? Any examples? We have this big, nice list that we've been compiling together that I'll eventually put into the website, but for now it's a Google document. But there's like a whole list of things that folks have brainstormed to write off. Any interesting ideas out there from the group?
I've done like my computers and things like that with the taxes and everything with that. But nothing major, and like you said, not like a Segway or anything that dramatic. But
yeah, I do my computer,
all my office stuff. Yeah, I do that, and I do the sales tax on it as well.
Yeah, iPads for the kids. Nah, just joking. Yeah. But actually, today I did buy. I have this nice backyard right now, so I was thinking about doing my podcast in the backyard. instead of doing it in some dusty old bedroom like this one. So I was gonna get these like fun tiki torches. I actually bought them today. I bought a dozen tiki torches and a gallon of the mosquito fuel. That's a problem. The mosquitoes drive me crazy, but I mean it's for my podcast, so
there you go.
That's 100%. It's like $120 that I can deduct, and I bought some stakes for it to jam into the ground. So that's an example of right there. In like with it being the first of the year, what I'll usually do come tax time is I'll go through all my Amazon purchases and eBay purchases, and it's like an annual thing I'll do is I'll just go down the list and I'll like just kind of think to myself, did I use this for business or was it necessary for business? And then copy all the receipts all at one time just to kind of batch my paperwork there.
Yep.
Be amazed what you can get. I mean, it's nothing crazy, maybe about $500 to $1,000 of stuff, but at the very least, it's a few hundred to $1,000.
Yep.
Any other interesting purchases to add to the list? Or questions? Any general questions before we move on?
Yeah, I was just wondering, if you have like just real estate, just properties, how do you determine what business that goes to?
Well, I think some part of it is the opposite of the question. How will the IRS determine that this hasn't gone to said properties?
Yeah. Yeah, normally like when you have different properties, you'll list them separate, and you almost like line item for each property, and then just add them up that way.
Okay, that's a good way. Good point.
Yeah, like just split them up and then show that this went to that, this went to that, and then I know people who used to do that, and they would do stuff with their house. Like I said, not me, but
yeah, a friend, yeah.
Do something to their house. They might have 3 rental properties, and then they split stuff up, and then it just so happened they had to do a roof on one, but it was on their main house instead of property. Like you said, how they gonna know who's gonna get on the roof to go check? But
right. And there's certain things that get itemized per the property that should get capitalized, which is kind of bad junk for us investors because you'd like to just take the deduction all in year one. Like for example, a big HVAC. But I believe in this note sheet there should be the exemption rule where if it flies under the radar at 2,500, I believe you can take it off all in the first year. Again, talk to your CPA for that. But yeah, so a lot of these smaller purchases you can kind of just write off year one. What I did is because I had 10 properties, of course, all the little things get put into the per property, but there's a lot of things I called overhead, like things that were necessary for me to do business, like a trip to California to go visit investors or something like that. That got put in a different spreadsheet that I called overhead. And what I did was I would put it on each individual Schedule E, I think individual property, and I would put it, I would prorate it based on the annual rents for each property. So if I had 2 properties, one that was 75% of the income, one was 25% of the income, and I incurred $100 expense for repairing my screen on my iPhone or something like that. $75, 75% would go to one and $25 would go to the other. And I built a spreadsheet for that, of course, so it's easy, but good question. So moving on, page 120, talk about property taxes. So maybe just if you're unclear on that, read that. Oh, here in capital letters, I want to ask if anybody has applied for tax exempt at the store. I know that some wholesaling stores will ask you like if you're tax exempt or not. I don't know if this really applies to us. This is more for like operational businesses that's buying and selling things, but something to keep in mind. And this is where like there's different CPAs for everything. In my opinion, Like if your CPA doesn't own property, doesn't own like double digits of properties, then I wouldn't work with them. They don't know. They don't have a clue. There was an example of this basement thing. I mean, there's these little nuances that I don't really get involved in this stuff anymore, which is why I don't like single family homes. There's just a lot of these nuances that are ways to kind of get extra dollars here and there. But in my opinion, as the investor, this is kind of going on beyond like what's needed. I think this is one of those things that they throw in the book to get you to go use them as a vendor. Yeah. Minority discount or marketability discount. I didn't really understand those, nor did I. It didn't seem like too impactful. Does anybody have comments on that? Page 145, the need to keep the entity the same in two different countries. And also they were talking about states too. I kind of chalked this up to like, this is the professional's job. They do like a 5 or 6 different states for my stuff. I don't have a clue what's happening at that point. The charitable remainder trust they talked about. I really like this idea, this charitable remainder trust. I'm a bigger fan of like my highest and best use is just growing money, way better than any retirement plan or charitable organization ever could think that they could. So I'm gonna grow it for them, and then I'm gonna give it away when I die. So here's what this thing you can do is you can set up this charitable remainder trust to give away to like, you can set percentages. Like I'm gonna send 35% to the Humane Society, $35,000 to church, 15% to my old high school, and 1% to your kid at age 25. So you get very specific, and then at that point, I believe it's tax free.
Hey, this is Reed. Can you hear me?
Yeah, go ahead, Reed.
Hey, so I kind of didn't like. I'm just like too much of the person that is like what's the word I'm thinking of? The other side of the opinion, I guess. But I kind of didn't like some of the stuff because it's like, okay, so you give it to charity, you give part of it to your parents or something. Well, that means it's that much that you don't get. I mean, yeah, you're saving maybe some of it is, but yeah, you're saving as far as like the total amount of taxes that are paid by somebody. So, but if you give it to your parents, then are your parents going to do some kind of shell thing where they give it back to you? I don't think he was referring to that. So it's kind of I don't know, some of it seems overrated.
I think what they're doing is like for example, the kids one. I think everybody who goes on a podcast and writes a book is saying that they're giving it to their kids, but in all practicality sense, you're not giving them a single penny. It's just a paper exercise.
Yeah.
I mean, yeah, technically, if an auditor gets you, yeah, you're paying for a whole bunch of stuff, so you technically are giving it to them. But as far as like family, I think that kind of same thought process applies to. I'm just speculating.
I think it's also like what they were saying last time about the 1031 exchange. You're gonna die. You keep kicking the can back until it gets to the point where if you don't want somebody to get too much stuff, then you do the charitable remainder trust to kind of divvy it up after you die. But you don't have to pay the gains on it as you go along, and it keeps rolling over.
Yeah, I mean, I hear, obviously we all know that, if your parents pass away, you get the step up basis, which is awesome. And unless you have a huge estate, usually is inherited tax free. But some people, they'll try and sharpshoot the system and gift their parents a lot of their own assets so they can get that step up basis on their own. They'll try and play the system. I personally don't really know how to do that. I know how to do it intellectually. I just never done it or never really want to do it. I'm just not in that situation. But I know people play that game. I think you got to talk to your own attorney or NCPA on that one.
I think that's like another one of those little things he was like using to get you to use his service because he knows how to do it. But it's a cool thing though.
Yeah.
Once you get to that point.
Watch taxes. Oh yeah. So same thing. Watch taxes made in different states. And I think that was it. That was pretty much all the content there. There's a lot of blah, blah, blah about somebody's past and story. It's kind of a dry few chapters. Any other questions, comments, or discussion items? So there's a chat question here. What's the best option to file single owner LLC? Shall combine with our own or separate? I don't really understand the question. If you can kind of type that again. I don't understand it. I don't quite understand. Any other questions?
I don't know. Now when it sounds like they're saying if you don't, I've done that before. Like if you don't have much income, it's not something that you need to separate yourself for liability purposes. You can put it on your own. But if it's something you're making, $20,000, $30,000, $40,000 of income from, then do it as a separate entity. I think that's what they're asking. Like, do you put it on your personal taxes if you're a single member LLC, or do you separate it and do it as a separate total tax? But
I mean, I'm not the expert at this, but LLCs are not, they're not tax entities, they're legal entities. And I think that's what everybody messes up.
right.
It's really nothing to do with taxes. It flows to you personally.
Yeah.
Now, the only thing that comes into play is now when you start taxing it as a S Corp or C Corp. Now we get started into this 21% higher or lower, then you have to pick a path.
Right. I think that's what they were asking. Like, at what point do you have to split it off and then separate it?
Yeah, I think the distinction came in, it was last time, I believe. Here, chapter 6 through 11 here, they're saying something, use a corporation to provide service to your LLC or S Corp to defer taxes if you're over the 22% bracket on ordinary income.
Right. There you go. You can almost do it from your personal income or from the income from the business. Makes you decide to, because it pushes you up to a certain point.
Right. And I still don't understand like the 5 different categories and how they offset each other, like the passive and ordinary and then that kind of stuff. I kind of understand it, but I think that's where the professionals come in. I think when you go find a professional, you gotta know what's at least 20% of it. Just like an investment, in my opinion. You have to know what you're doing. You don't need to know everything.
Enough to be dangerous.
Right. Or enough not to get screwed over. Right. I mean, so many people, they pay like 9 hours for a plumber to do a simple unplug job, right? And that's like the classic case.
Yeah.
Any
I
other?
think the hard.
Oh, go ahead.
I know the other hard thing too is I think he just started that next section of the book where now he starts also talking about asset protection. So I think that throws a whole nother wrench when you start thinking about from the tax side as well as from the asset protection side. And I know he was trying to talking about LLC partnerships with an S corp behind and all that stuff. It's just like, okay, now it's getting really
See, and
complicated.
And they start to talk about like, are you driving a Ferrari or driving a Honda? Right? Like, let's set you up for like something that's like decent. I mean, it's so funny. Like I talk to so many guys and they're broke, right? They're under 200 grand net worth, and they're trying to do all these elaborate like LLCs and stuff like that. And just the fees on those LLCs is going to eat them alive. It's just not practical. I mean, it's not until you get up to like $1 million, $3 million net worth until you start employing those larger strategies, in my opinion. But people can do whatever they want. But I think people will use that stuff as sort of a defense mechanism, as an excuse not to do anything. In my opinion, it's very simple. Go get a property, then as you're getting that set up and getting it going, get an LLC and put it in there as you grow your portfolio.
I ended up getting an umbrella policy, but that was just like $190.
Right. I mean, that's the first thing that you should do, I think. But as we know, the insurance companies always like to try and fight it, right? They're not guaranteed to be there, nor is a LLC. So, that's why you have these multiple strategies.
So I had a question about just the verbiage that they use sometimes, the distinction between a tax advisor and a CPA. I mean, they can be one and the same, right? I mean, does anybody have a separate advisor and a CPA?
Well, the example that is like, I think a CPA is more of the technical side. The attorney really should be the leader, I think, because they have a bigger scope, right? Like a attorney should know that if you're selling an asset in a corporation, that now you're going to trigger certain taxes, even though that's traditionally you're thinking that that's a tax item. So they go hand in hand, and a lot of times it can be counterintuitive what you're trying to do. Like we said, an LLC is not a taxing thing. It's more of an asset protection thing. So a lot of the times the strategies can kind of they can conflict. Just like two doctors prescribing different medications.
Yeah.
Yeah, and I guess in the book he's also trying to maybe make the distinguish where he's just saying a regular CPA just does your taxes, just files it once a year, and he's trying to say, well, there's another layer where there's a tax planner. These guys that are supposedly more experienced and help you, I guess, plan it out for maybe your life or whatnot.
Right. I mean, there was one section where it said you need to be talking to this guy at least 4 times a year, or he's not doing his job. And I'm just trying to clarify if that's the guy that at the end of the year is going to be doing your taxes, or if he's actually suggesting you have somebody in addition to that.
Yeah, he's making it. The way he's presenting it is he can do both.
Yeah.
If you don't have somebody that can do both, like Lane said, get an attorney and have a CPA, but he's both a tax advisor and a CPA, so you kind of get both in one stop.
Yeah.
Yeah.
That's what I suspected.
That's what, exactly.
And by the way, get your baseball gloves out because the pitch is coming, right? I mean,
it's coming fast too.
Yeah. All right. Any other things left for the cause?
I guess another. I
Okay.
did kind of have something to pop up in mind. At one point I was even thinking about investing in those like coffee parcels. I was kind of wondering. I mean, is there any like what do you call it, foreign tax credits that apply to some of that stuff?
I don't know, man. I don't know. I mean, like I read through the foreign tax part of this thing, and I'm like, the only things I know about that is like certain countries play nice together, right? Like I think Canada, United States. So if you're investing in here and you get taxed here, Canada will be like, all right, cool, this guy paid his taxes. There's kind of sort of international tax treaties like that. But I mean, for the most part, that's where you need a professional. Right. And I think your job as an investor is to be like, play stump the chump with your professional and say, hey, explain this to me, All right. So I think we are coming up to the end of the book, and I've got my interview with Tom Wright coming up here soon. I feel like the book is kind of coming to a slower pace, which a lot more, and then the pitch is coming, right? So I'm going to propose that this next week we're gonna do double time and we're gonna read. We're just gonna get it done and finish off the book. It was pretty quick to read this last chunk, last 50 pages, I think. So we'll do that and we'll wrap up next Friday, and then always trying to give you back more time, right? Because time is the most valuable resource here. But yeah, if you guys like these kinds of things, let me know. I'm going to be rolling out that group coaching thing and looking for some founding members for that. But enjoy your weekend, and we'll talk to you guys later.
See you guys.
Thank you. Appreciate it.
Bye.
Have a good weekend.